We are currently hyper-focused on the artificial intelligence bubble and the noise of the next election cycle. But the duct tape quietly holding the global financial system together is starting to peel. This creates a paradox. The Federal Reserve signals that they are ready to ease policy, yet out in the real world, financial conditions remain restrictive. You see this when mortgage rates refuse to fall, and the stock market experiences sudden, unexplained volatility, despite cooling inflation data. Hyper-analyzing Jerome Powell's press conferences won't explain this disconnect. The Federal Reserve is pulling a lever that affects short-term overnight rates, while the long-term yields that drive the real economy are responding to a different set of global pressures. To understand why the Fed is losing its grip, we have to look at what they actually control. Their authority is limited to the very short end of the market, specifically the rate banks charge each other to lend money overnight. But as we move toward the 10, 20, and 30-year Treasury bonds, the Fed's influence fades. These long-term yields are the backbone of all asset returns, and they are dictated by a cold calculation of global supply and demand. On the supply side, the United States is running trillion-dollar annual deficits. To keep the lights on, the Treasury must issue massive amounts of new debt every single year, flooding a market with bonds. For decades, this system worked because of a consistent, massive foreign buyer that absorbed that debt without question. That buyer has just backed out. For 30 years, Japanese institutions faced an economy with no growth and 0% interest rates. If you were a pension fund or a bank in Tokyo, keeping your money at home meant earning nothing. You were forced to look overseas. This hunt for yield turned Japan into the world's largest net creditor and the single largest foreign holder of United States treasuries. This capital flow was driven by the carry trade. Step 1 is simple. An investor borrows yen at near 0% interest rates. In step 2, they convert those yen into dollars and buy U.S. treasuries, yielding 4%. Step 3 is the payout. Even after currency hedging costs, the investor pockets a reliable mathematical spread between the 0% loan and the 4% yield. It was like the global markets were running on Japanese Wi-Fi. It provided the cheap liquidity that propped up U.S. tech stocks and real estate for an entire generation. The entire trade relied on one assumption, that Japanese yields would stay near zero forever. In 2024, that assumption broke when the Bank of Japan raised interest rates for the first time in 17 years. The math instantly inverted. Borrowing costs spiked, currency hedging became expensive, and the 4% treasury spread vanished. The trade was no longer a no-brainer. This triggered a massive wave of repatriation, a process where foreign investors sell their U.S. assets to bring their capital back home. The cheapest source of global liquidity for the last 3 decades is now draining out of the U.S. system, resetting the baseline cost for every American asset class. When your most consistent buyer leaves the market, yields must rise to attract new demand. This keeps the long end of the bond market elevated, even if the Fed tries to cut rates. This creates a direct hit to the stock market through discounted cash flow models. When the baseline treasury yield stays high, the present value of a company's future earnings mathematically decreases. This valuation compression is why tech and AI stocks can trade lower even when their earnings are strong. Investors are simply no longer willing to pay the same premium for those future profits. The housing market faces a similar squeeze. U.S. mortgage rates are anchored to the 10-year Treasury yield, not the Federal Reserve's overnight rate. As long as the global demand for our debt remains weak, the long end of the curve will stay pinned. This keeps mortgage rates high and refinancing activity muted, and home transactions slow. This ripple effect eventually hits corporate credit. The era of cheap, easily accessible financing that fueled the post-2020 boom has ended, leading to slower deal flow and reduced risk appetite across the board. We are being sold a narrative that one Fed rate cut will fix everything and that liquidity is automatic. But that assumes a buyer will always be there to cheaply finance our massive debt issuance. The systemic evaporation of global liquidity represents a fundamental shift in how the bond market functions. As this capital returns to its home markets, the U.S. economy enters a new phase where the cost of money is no longer a choice made in Washington, but a price set by a global market that is finally demanding more.